Welcome to our Research and Development Tax Credit for Software Development webinar. KBKG was established in 1999. We have offices across the U.S., including Illinois, Pennsylvania, Arizona, Ohio, Georgia, New York, Texas, and Pasadena, California, where we are headquartered. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize our results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. Now I'll introduce our speakers. Paul McVoy is a director for KBKG's tax credit consulting practice. In this role, Paul devotes his time to consulting companies in maximizing their R&D tax credit claims. Prior to joining KBKG, Paul was a manager at a Big Four accounting firm out of the Philadelphia, San Diego, and LA offices. Paul has spent more than 10 years in public accounting, leveraging previous tax compliance and tax provision work experience to provide focused and thoughtful advice regarding the research and experimentation activities of his clients. Michael Marini is a senior manager with KBKG and advises clients on tax matters related to federal and state research and development tax incentives. He has 20 years of experience working on tax reviews ranging from sophisticated multi-year claims to short-term consulting projects. He has advised hundreds of clients across a variety of industries, including aerospace and defense, manufacturing, agriculture, pharmaceuticals, communications, industrial products, consumer goods, software technology, and energy. Now I'll turn it over to our speakers.
Thank you, Jackie, and welcome everyone. We appreciate you taking some time to spend an hour with us today on this webinar. Here's the agenda of the items we're going to cover on today's webinar. We're going to start with the discussion about the impact of the software development industry as a whole. Then we'll provide an overview of the R&D tax credit, the impact of the PATH Act of 2015, and how to maximize the incentive's value. Then we'll wrap up by discussing other IRS audit considerations when claiming the R&D credit. And I encourage you, as Jackie said, to submit your questions in the chat box. During the polling questions, we'll try to answer as many of those questions as we can. So let's go ahead and get started. So software development has really transformed today's business environment. It's really essential for companies of all sizes, really, to prioritize innovation to remain competitive. On this slide, we've provided a few examples of industries that are undergoing a revolution driven by software development. High-quality software coding is critical across all industries. Software development activities ensure data integrity, personal privacy, and many other benefits as well. Recently, there's been a substantial increase in software development related to these specific areas. Mobile application development. It seems like every business has a website and every business has a mobile app. Cybersecurity is very critical and is ever changing, trying to stay ahead of the next threat that's coming. Machine learning, cloud computing is also big. No longer do you need to have an application running on your machine. You can access that application through the cloud. And natural language processing. Okay, next we're going to review the typical software development lifecycle. So this is an overview of the software development process, and it's helpful in determining whether a process of experimentation, as defined in the Code and Treasury regulations, is present. As part of this discussion, we're not going to go into too much detail on how to calculate the R&D credit, but we will be talking about the four-part test. What types of activities qualify for the credit. And one part of that is a process of experimentation must exist whereby you are evaluating alternatives. And so as part of the software development lifecycle, that's kind of at the very heart of what software development is. It's experimenting with different codes and different techniques in order to get the right response that you're looking for. Software development generally involves a cycle of requirements and analysis and specification, design or coding, product release or implementation, testing, and product evolution. And based on the results of any or all of these steps, the software development activity may need to repeat one or more of these steps. For example, assume a product development life cycle was in its testing phase and a new requirement was introduced for competitive or compliance reasons and had to be incorporated into the product before release. Then the new requirement would have to be designed into the product, which in turn could affect the existing design and coding of the software already written and tested. So let's walk through each of these segments really of the software development lifecycle. First, we have requirements analysis. Requirements analysis sometimes requires individuals and teams from the client as well as the service provider side to get detailed and accurate requirements. And often there has to be a lot of communication between these groups to understand these requirements. Requirements gathering is the most crucial aspect, as many times communication gaps arise in this phase, and that leads to validation errors and bugs later on in the software program. Then we have the design or coding phase. In systems design, the design functions and operations are described in detail, including screen layouts, business rules, process diagrams, and other documentation. The design stage takes as its initial input the requirements identified in the approved requirements document. And for each requirement, as a set of one or more design elements will be produced as a result of interviews, workshops, and prototype efforts. Design elements describe in detail the desired software functions and generally include functional hierarchy diagrams, screen layout diagrams, tables of business rules, business process diagrams, and so forth. These design elements are intended to describe the software in sufficient detail that a programmer then can develop the software with minimal additional input. Next, we have implementation, and this is, modular and subsystem programming code will be accomplished during this stage. There's also some unit testing and modular testing that's done in this stage by the developers. And the stage is intermingled with the next testing stage in that individual modules need to be tested before integrating them into the main project. Then we have our testing phase, and this is where your the unit, system, and user acceptance testing is often performed. I won't go into all of the different types of testing that are performed here. Just a few. There's defect, path testing, system testing, and integration testing. But basically, every time that a code has been updated or changed or written, there needs to be tests to determine what effect did that change in the design have on the module and then the system as a whole. And then finally, we have evolution on here because, as the system is deployed and used, there is feedback that's given. There are new requirements that are always being implemented for the next generation of this software and the next software release. So then that brings us back to the beginning with new requirements and analysis and specification, designing, implementation, testing, and further evolution. So next, Paul is going to provide an overview of what the R&D tax credit is. Paul?
Thank you, Michael. So the R&D tax credit is a Section 41 credit for increasing research activity that was originally enacted in 1981. And at that time, it was a temporary code section and stayed as such until it was permanently extended as part of the PATH Act in 2015. The Section 41 credit is a federal statute. However, many states offer some form of research credit which borrows language from the federal statute. And one thing that's important to note is that although there are billions of dollars of research credits claimed every year in the United States, there are still billions of dollars which go unclaimed. And the Section 41 credit is a general business credit which typically ranges from 7 to 10% of qualifying research expenditures. As such, it's a dollar-for-dollar reduction in the taxpayer's income tax liability, and pass-through entities such as S corporations and partnerships can also claim the credit. The benefit just happens to flow through to the individual shareholders or members' respective K-1s. So the R&D credit can be claimed for all years under statute, and all unused research credits can be carried back 1 year and forward up to 20 years for federal purposes. So this is a very lucrative credit, and even though many people are currently taking advantage of it, we still believe there's many people who aren't, and that's either due to a lack of awareness or a lack of an understanding of what's required in order to claim that credit. So on the next slide, we'll talk about who qualifies for the R&D tax credit. So the individuals that will qualify for the R&D tax credit is any employee who's performing qualified activities, as well as any employee who is directly supervising or directly supporting R&D activities. If we make payments to an outside contractor or basically a third party to perform R&D on our behalf, we're able to claim the costs associated with that, but that would be subject to a 35% haircut. I think the most important thing to note related to qualifying activities and qualifying services being provided to the company is that the activities must be performed in the United States, as it is a domestic tax credit. So in my experience, what we'll see is generally some companies will outsource their software development, could be to Ukraine or to Colombia, wherever it is, and those types of costs would not be eligible to claim towards the R&D tax credit. So there are some things that are within the gray area which we may be able to claim as qualified supplies, but we can talk about that as we work our way through this webinar in future slides. So on the next slide, we have the general R&D tax credit overview, and this is the 4-part test. And what the 4-part test represents is the requirements in order to qualify for the R&D tax credit under Internal Revenue Codes Section 41 and Sections 174. Often when reference is made to R&D, people think about lab codes and test tubes, but in reality, R&D tax credit tests are much more broad in application, and provided we meet these 4 tests, we'll have an opportunity to claim the credit. So for activities to qualify, and again, this is an activity-based credit, so if an employee is performing these activities that meet this test, we'll be able to claim the expenses associated with that activity towards the benefit. So these tests are to be applied at the business component level, and a business component is just a fancy tax term for saying what we are holding for sale. It could be a product, a process, a technique. For purposes of this discussion, probably a software platform, could be an application. It could be a piece of hardware with software written into it. So anyway, moving forward, the first test is called the technological in nature test, meaning the project must fundamentally rely on one of the hard sciences, such as biology, physics, chemistry, or computer science or engineering. So for purposes of this call, generally what we would see qualifying would be computer science or computer engineering. And we'll talk more specifically about software on the next slide and its application of the 4-part test. The second test is the permitted purpose test, and this has to do with the objective behind the research. The objective must be to improve the functionality, the quality, the performance, or the reliability of the said business component, new or existing business component. The third test is called the elimination of uncertainty test, meaning at the outset of any initiative or any project, there must be a degree of uncertainty related to the appropriate design of the business component or the capability or methodology for improving said business component. Lastly, the 4th test is the process of experimentation test, which works hand in hand with the elimination of uncertainty test. And this requires substantially all the activities performed to constitute a process of experimentation, which is defined as an evaluation of different alternatives to eliminate the uncertainty identified at the outset of the project. So on the next slide, what we'll do is walk through this 4-part test as it relates to software development. So now that we have an understanding of what requirements are necessary for an activity to qualify for the research credit, let's see what they look like when we're talking about application development or platform development. So let's say we are speaking with a company who is developing an app or developing a new sales platform to roll out to their customers. We would walk through the 4-part test and reconcile the activities that they're performing to what's required by law in order to claim the benefit. And the first test, again, would be the technological nature test. And we would say, what activities are you performing that rely on one of the hard sciences? And the response would be, well, we're developing the application. We are creating this brand new software platform. So the activities would rely on the fundamental principles of computer science or software engineering. So as we move forward, we'd say, okay, well, now that we've passed the first test, let's talk about the permitted purpose test. And a permitted purpose test is to identify which business component we are working on and what the objective is. So in the example that we were talking about, we would say, what are we working on? Well, that's a brand new platform that we're trying to, a software platform that we're trying to roll out to our clients so they can work through in order to buy our product or to make reservations, whatever that product is. Or we're developing an application for mobile devices to roll out. So that would be considered the business component, and in creating that brand new business component, we would meet the second test, or the permitted purpose test. So now the third and fourth tests, which work in concert together, the elimination of uncertainty test, we would say, okay, well, at the beginning of that project, what was uncertain about the platform or application development? And generally a response would be, well, we understand, we know we want to create this platform and we want to develop this application, but we are not positive on the appropriate design of said application or software platform. And what that means is we can hire the best of the best software developers and coders and programmers, and generally, because uncertainty is inherent in the software industry, they're going to code, their first iteration of code will not be what is final. Meaning the first alternative that they're considering, the first iteration of code, because that's not final, will result in another iteration or another alternative. And that is a perfect segue to the process experimentation test, meaning, are we going through this iterative design and analyzing each version of code or each alternative that's available before finalizing, either discarding the project, we can't make this app, or we can't make this app the way we want to, so we have to go a different direction, or analyzing the alternative before finalizing and saying, okay, we've gone through 10 different iterations as far as the coding's concerned, and we have finally gotten to a point where we can roll this out within the App Store. We can put this into testing mode from a platform standpoint. And then when we move to version 1.1 or 2.0 of that application or of that platform, we can claim the costs associated with that, again, if we meet this 4-part test. So to the extent a given project meets all 4 parts, or the 4-part test, we're able to capture the expenses associated with the project towards the research credit. And generally the types of expenses which we will qualify are wages, for people performing the R&D or directly supervising or supporting it. Qualified supplies, which would be items that are used and consumed in the research process. For example, if we're building a prototype piece of hardware that we're writing software on, we may be able to claim the entire cost of the hardware or any of the supplies. Generally, supplies can't be capital in nature, so we can't qualify land or machinery and equipment, but there are instances, if we are creating a prototype, that we may be able to claim that increased cost. The third category is contract research expenditures, which are, again, payments made to third parties to do R&D on our behalf. Again, those payments that we're making are subject to a 35% haircut, so we can take 65% of those costs. That's the third bucket. And then the fourth bucket, which we see within the software development industry more than anywhere else is the rental or lease of computers or cloud computer costs incurred for the purposes of developing or improving software. Meaning, if we are working with Amazon Web Services, for example, and we are running an environment that's strictly for testing and is R&D in nature, we can claim the cost associated with the R&D specific testing environment. So that's important to keep in mind, and generally it won't be a huge cost for clients and taxpayers, but it is a cost nonetheless, and we want to ensure that we are taking advantage of the benefit that we're entitled to. So I think now Michael will discuss an overview of qualified and non-qualified activities. Michael.
Great, thanks, Paul. So as mentioned earlier, the R&D credit qualification is activity-based. So it's important to understand that the activity being performed will determine whether we can qualify for the research credit. So here's an example or sample of typical qualified activities that we see in the software industry. So there's developing new or improved technologies, designing software architecture, establishing the functional relationships between the software modules, programming and testing software source code, conduct unit integration, functional performance and regression testing, as well as developing any new feature enhancements, and conducting analysis for functional software end requirements, and establishing and evaluating functional specifications, and many more. Basically everything from the design of the software to the testing and implementation of that software can qualify for the credit. Now here is a list, a short list of the non-qualified activities. This is not an all-inclusive list, but will kind of get you thinking in terms of what may not qualify. Any routine maintenance of or support of an existing software application. If there's software application configuration, in other words, the functionality already exists within the software, you're simply configuring it to a particular a customer or a set of facts. Any type of reverse engineering does not qualify. So let's say you want to figure out how to write the code that's going to produce a certain result. So you download the code that you know works, and you try to reverse engineer that. That's not considered R&D. That's more deconstruction versus actual construction, if I can use those terms. Performing studies or activities to select vendor products is not going to qualify. In other words, researching to see if this particular software or software tool is going to perform for you just by reading specs is not going to qualify as R&D. Upgrading to newer versions of hardware or software or installing vendor fix releases is not considered R&D. So going back to the four-part test, even though upgrading to a newer version of the hardware or software would in fact give you more features, more functionality, and all of that, simply updating your system to a new version isn't really R&D. Data quality, data cleansing, and data consistency activities. In other words, testing to see whether the data is clean or consistent. That's more considered routine quality control versus new product development or new software development. And then finally, bundling existing software products into product suites is not considered R&D. In other words, you have these different modules that you might bundle for marketing purposes or what have you into a new quote unquote product is not really research and development. With that, I think Paul's going to talk a little bit about the internal use software regulations that came out a few years back.
Thank you, Michael. So at the end of 2016, the IRS issued some final regulations providing guidance on the qualification of internal use or internal use software, IUS, for purposes of Section 41 and the research credit. And why that's important is because the determination between internal use software and external use will result in additional tests that need to be met in order to qualify the expenses associated with it. So the definition of internal use software is software that's developed for the taxpayer or by the taxpayer, primarily for use in general and administrative functions, which facilitate or support the conduct of the taxpayer's business. You think financial management functions, human resources, things of that nature. And if software development is related to strictly internal use, is strictly internal use, we have to meet an additional 3 tests in addition to the 4 tests that we talked about previously, and basically saying, hey, this software is innovative. If the first test is whether or not the software is innovative, and if the development is or would have been successful, the result would have been a substantial or economically significant reduction in cost or improvement in other performance standards. The second test is the development involves significant economic risk, meaning the taxpayer has to commit substantial resources to the development, and due to the technical risk, there's substantial uncertainty whether those resources would ever be recovered in a limited amount of time. And lastly, is that software cannot be commercially available, meaning taxpayer cannot purchase, license purchase software or lease software without substantial modification or expenses. So we have to pass a 7-part test in order to claim the costs associated with that. Now, whether or not the software is deemed internal use or non-internal use depends on the intent of the taxpayer and the facts and circumstances at the beginning of development. And why that's key is because this is crucial, and it's a critical determination that needs to be made, because a lot of times what we'll see is companies who have a new initiative to roll out a piece of software into the future, but they start development internally, meaning if it works well internally, we're going to roll it out commercially at some point. And it's important to document that if it works out that well and we're going to roll that out in the future commercially, to document that somewhere, because we may be able to treat those costs as non-IUS and only meet the lower threshold or the 4-part test in order to qualify those expenses. Even if the chance that we roll it out commercially is low, we still want to document that is in the back of our minds, because again, if we do that, we can claim it as non-IUS and then likely have a larger benefit related to our R&D spend. So one other thing I wanted to go through is the definition of software that's not for internal use. And basically any software that's developed to be commercially sold, leased, licensed, or otherwise marketed to third parties would be considered non-IUS. So this can be anything, a platform, an application, anything we're going to try to make money on in the future would be considered non-IUS. Some other definitions that were included in the final regulations include connectivity software, and a lot of times this is referred to as bridging software, middleware, or integration software, which allows multiple processes to run on one or more machines to interact across a network. And this software should be specifically identified or categorized differently from other types of software. And then whether it's considered IUS will depend on the function the software provides rather than the nomenclature. Another large item, or I think an important item to consider, is dual function software. So many times general and administrative software will also allow interaction with third parties. For example, if we are implementing e-commerce on our websites or on our application, let's say a mobile application, mobile device application, if this software is designated as dual function, it allows a taxpayer to identify a subset of software development which actually interacts with the third party, even though it was generally intended for internal use. And that allows the taxpayer to take a safe harbor, and the safe harbor means the taxpayer can include 25% of the qualified research expenditures provided third parties interact with the software at least 10% of the dual function software you use. So third party means any corporation, trade, or business, basically anyone that's using the software outside of the company. So with that, we'll move forward. So next we are going to work through a internal use software example, and this is just to get the gears running inside your head to see if one of these would be applicable for you at the company. So a Salt Lake City based company created a new billing system to replace its legacy system, and the new system would automate several manual functions. Although it would have some client facing features, it was primarily intended for internal use. So when you see a fact pattern like this, the light bulb should go off. Number one, it's an internal use project at first, meaning we're going to have to meet that 7-part test. However, the last line is important because it says it will have some client-facing features, although it was intended for internal use. And because of that, we want to understand if the dual function software safe harbor is available. And it would be in this instance, provided the development related to 10% or more of what will face what will be third party facing. Because of that, we can take 25% of the QRE. So in this instance, because there's 4 software engineers, even though there's 4.6 million of employee wages, 200,000 of which qualify, we would expect a federal credit of $20,000 and a Utah state credit of $20,000. So it's something to keep in mind if we're implementing any sort of projects internally that will touch our third parties or our end users, and we may be able to take advantage of the credit in those scenarios.
Paul, if you wouldn't mind going through and talking a little bit about what changes the PATH Act made to the R&D credit.
Absolutely. So the PATH Act signed by Obama in 2015 was absolutely groundbreaking as far as the research credit is concerned. First and foremost, the R&D credit was permanently extended, allowing anybody who's previously taken advantage of the credit to continue to do so. The second and third changes were equally as large. And the second big change is that the R&D credit could now be utilized to offset payroll taxes for qualified small businesses. And lastly, qualified businesses can now use the R&D tax credit to offset alternative minimum tax. And why is that important? Well, prior to the PATH Act, startup companies, let's say in the biotech industry, in Silicon Valley, any software companies who are creating applications, creating new platforms, creating new things that are going to change the world, we're incurring lots of expense and employing some of the best and the brightest minds, but not reaping any rewards for that innovation. And what a qualified small business is defined as a company that has not had gross receipts within the 5-year period ending in the current year, and less than $5 million in the current year. And if we meet those two requirements and we generate an R&D tax credit, we can utilize that R&D tax credit to offset our payroll taxes, or at least the employer portion of the FICA tax that is due. And that's important because it allows the companies who are in the startup phase and who are in the growth phase to monetize the R&D credit for all the innovation that they're doing. So that's very important and something to keep in mind for your clients or as a tax preparer or a CPA. The second big test is the alternative minimum tax rule, where eligible small businesses can now use the R&D tax credit and treat tentative minimum tax as 0. And what that allows us to do is take the R&D tax credit against AMT. And this again is something that we had not been able to do so prior to the PATH Act. So it opens up just a brand new audience for companies performing R&D who may have been limited by AMT in the past to take the credit. So I know many people on this webinar may be thinking, well, the corporate AMT was repealed, so what are you guys talking about? Well, that is true. The corporate AMT was repealed, but the AMT is still available or is still there for for flow-through entities and personal taxes. And it's important to understand that if a company who's averaged less than $50 million, and this is what is the definition of an eligible small business, averaged less than $50 million over the last 3 years in gross receipts, can utilize the credit to offset AMT. So that's very important. We'll work through a couple of examples, and again, these examples are for your reference. If you download the handouts and the slides, and there's something that catches your interest in the future, you can always refer back to these and refer back to these slides for some of the case studies. So here is an example of the payroll tax offset, and this is the application of how we would claim it. So here's an example of a qualified small business, and in this example, the software developer began operations in 2018 and is developing a new mobile gaming application. Obviously, the company is pre-revenue and a startup. It's operating as an S corporation. It has 15 employees. It has 0 gross receipts. However, it does have qualified wages of $2 million. And in that instance, we'd expect R&D credits of about $200,000, and their payroll taxes are $125,000. So the company, which plans to file its tax return in 2019 tax return in September of 2020, can apply the R&D tax credit to its payroll in the first subsequent quarter after the income tax return is filed. So if we're filing our income tax return in September, the next quarter, October, November, December, we're able to claim the payroll offset with our 941 filing for the October, November, December period. That's crucial because, for example, we're in June right now. It's June 9th, 2020, which means any companies who want to claim the payroll offset in the third quarter for calendar years, presuming it's a calendar year, would want to get their income tax return filed by the end of June. If not, let's say they file it July 1st, it would push the date in which they would get the tax refund or the cash refund up to 3 or 4 months in addition to what they have to wait anyway with the 1 quarter subsequent rule, waiting 1 subsequent quarter in order to utilize that rule. So with that, I think Michael will go through a couple of more case studies, again, for your reference to refer back to in the future if you have any facts and circumstances that may align with this. Michael?
Oh, terrific. Thank you. Thank you for that. So again, the format of these case studies will look very similar from slide to slide. So I encourage you to download the presentation and kind of go through these at your convenience. But basically, we've got some just here on the left side is really kind of the numbers side of things, and over here the qualified activities that are being performed, or the qualified projects that are being performed. So again, this is more for your benefit to look and see, are you performing these types of activities? Are you designing 3D graphics, sound animation, proprietary motion caption software, for instance, in the video gaming industry, or do you have clients that are doing that? This is just simply to say, hey, if they've got 10 engineers and the employee wages are this, these are the types of credits that they're able to claim each year. So I just would encourage you, go through these. There aren't a lot of them. There's probably 4 or 5 of them. But just in the interest of time, I think we're going to skip the case studies and just have you refer to those after you download them. So let's see where that takes us with regards to the okay, so with regards to the AMT offset, this is just an example of how that would work. So here we've got a company in 2019 generated 331,000 of R&D tax credits. Their 2019 tax liability was 219,000. That consisted of both regular tax liability and AMT liability. And prior to the prior to the PATH Act, they weren't able to utilize any of their R&D credits. They had to carry them forward. But since the PATH Act, they're able to utilize a good chunk of them. Here, the 178,250 of the total 219. Of the total, 219,000 of tax liability, 178 of that is satisfied by the R&D credit now. So again, a major change when it came to the R&D tax credit. So I think, Paul, why don't you take over here and talk to us a little bit about how do we maximize the value of the R&D credits for software companies?
Thank you, Michael. As far as maximizing value, we'll really want to look into areas that may be considered gray, or really the areas that are often overlooked when performing R&D studies. So anytime we're developing software, the light bulb should go off that, hey, an R&D credit may be available. And generally we will think that the software that we're developing is the only thing that we can qualify, and the people performing the direct R&D that's related to it. But in reality, we're able to claim not only the people who are doing the software development, but one level removed. So an area where people often do not claim the benefit that they're entitled to could be high-level executives who are driving product strategy. A lot of time for startups, you'll see founders, CEOs, different things like that, who are available to take the R&D tax credit. We're able to claim their costs associated with the tax credit. What we want to do is we want to be cognizant of the job titles that we're claiming, but not have them preclude us from claiming credits for other individuals. Many times in the software industry, you'll see sales teams who are corresponding with the end users or the customers, getting ideas for new functionalities, for future iterations of the software. And in those instances, we're able to claim the time associated with those sales individuals. If we have stock compensation plans, we want to ensure that we're documenting the types of R&D that's being performed, because in the future we'll be able to take those stock options as they're exercised. Obviously, whenever wages increase, they may incur more scrutiny in future tax controversy, but we'll be ahead of the game if we're documenting the R&D that led to those big stock options and exercises. An easy example to think of is Apple. Apple was paying Steve Jobs in the 80s, and when Apple really increased their market cap, and Steve Jobs and those types of individuals were exercising their stock options, they were for a lot more than they were being paid in the 80s. And because of that, you'll want to have an idea of what was being performed that enabled them to be granted those stock options. So that's one place to think. And then anytime we are looking for, anytime we're utilizing cloud computing software, we want to understand if any of that is related to an R&D specific environment. And if we're, let's say we are, and I know this question came up earlier, but let's say we're self-employed, or we're working as one of the members of an LLC. If we have any wages that are subject to self-employment tax, that could also increase the qualified wages that we are able to claim towards the R&D credit. So it's important to do a detailed analysis of the types of costs that may be eligible for claiming the R&D credit, because again, this is a dollar for dollar benefit against your tax liability or against your payroll tax liability. That's not a deduction. It's basically 3 times as lucrative as a deduction.
Here are some of the audit considerations that we find when you do claim the credit. Number one, I don't want to scare you off. The audits are few and far between when it comes to the R&D credit. It used to be a tier 1 issue years ago. when you did amend to claim the R&D credit, you were flagged for audit. That is no longer the case, has not been the case for several years. So now claiming the R&D credit carries no more risk than does any other credits or deductions that you take. If you are audited, though, and you are claiming an R&D credit, they will look at that, and you'll need to substantiate those costs. So one thing we talked about internal use software. So if you do have projects that you're the software you're creating is intended for your internal use. We talked about some of that. You want to make sure that you can identify which portions of that, if available, are client-facing versus internal use only, general and administrative in nature. Not that they can't qualify, but they just need to meet an additional 3 tests in order to qualify. Also, there's funded research. When we're looking at either you paying a third party to conduct research on your behalf, or if a customer is coming to your client and asking for them to design something specifically for them, your client, the taxpayer, in order to claim the credit, has to have the financial risk of failure in there. And what we usually see is in the form of fixed price contracts or fixed fee engagements, where your client's customers are asking for a successful solution and paying a fixed price for that. Your client must also retain what's called substantial rights under to the technology under development or in the results of that research. Does your client under that contract have to ask their customers for which they are performing this work for permission to use the results of that research in creating the same or similar solution for somebody else? And where you look for that is in the customer contract and outside services agreements. Also, we talked about owner operators. If it's an S corp, either an S corp or a pass-through entity or a sole proprietorship, if you have an owner who's also a lead developer, let's say a software developer, that could be a red flag. And so we would want to make sure that you're documenting those activities of that owner operator in the event of an audit. Highly compensated employees as well. We kind of talked about that with the Steve Jobs example. If the fact that you're paying yourself a bonus or a high salary, we want to make sure that we are documenting those activities so that we can defend successfully under audit. And finally, there's contemporaneous documentation. That's usually project documentation. And to that end, I'll go to our next slide. This is our final slide for the presentation, where this would really be the project documentation that you'd want to collect and maintain for each of your R&D projects. But one final note I will say is that, based on your analysis as to where the credits are, who's generating these credits? Are they highly qualified people? Are they highly compensated people? Are these customer projects versus internal R&D projects? Depending on where your projects or your credits, the qualified expenses are coming from, that's where your focus should be when it comes to documenting that. You want to make sure you're documenting the majority of your qualified expenses, or at least the most significant sources of those expenses.